Welcome back. This morning we had a revision to the GDP, a little bit slightly higher than the previous month's estimate, however, still indicating very much a recession. I thought it might be helpful to take a look at some of the big macroeconomic forces which go to determine the trends in our economy and the stock market. Now, the white area chart over here is the S&P 500. Now, the way this chart works is we're essentially ranking every single month's estimate compared to the past 12 months, 12 months. So, for example, the S&P 500, the latest figure, which is registering on a 40%, that's 40% of the past 12 months reading. So it's relatively speaking on the lower end of the past 12 months worth of figures. The red line represents CPI, Consumer Price Index, which reflects the level of inflation. The blue line represents GDP, Gross Domestic Product. And of course, GDP is only released once every quarter, but we do have monthly revisions on a regular basis. And the green line represents residential construction. I thought it might be helpful to compare the different major components within an economy, such as inflation, the CPI, the red line, GDP, which represents growth, and the green line, which loosely reflects the state of the housing market, and compare and contrast that to the performance of stock prices. Now, going back to the left-hand side of the chart, this goes back to 2014. We had a little bit of a dip in 2015 to the downside. Stocks did retreat, as well as the green line, which is residential construction, and the red line, which is CPI. Now, the purple jagged line over here is essentially just a composite, a comparison of all the indices put together. It just shows you a rough average of the economic factors. Now, with that said, we can see that in 2014, 2015, we did have a dip in stocks. We had a dip in residential construction and housing, in the housing industry, as well as in inflation. However, notice the blue line GDP, gross domestic product, really did not dip very much to the downside. In fact, it continued to trend higher. And it really does show us a divergence in the different economic reports, meaning that while the housing numbers tend to be very volatile, as well as inflationary numbers for that matter, the green and the red lines, the GDP is less volatile, and stocks also tend to be quite volatile. And I think this divergence between the more and less volatile economic numbers really helps us to gauge where we are within the big picture. Are we in a slight recession? I mean, technically, 2 quarters of negative GDP of contraction does classify as a recession, but is it a minor recession, or many think that maybe this is the beginning of something much worse? Now, moving to 2018, we saw again the green line, residential construction, move to the downside, but that was about it. In addition to, of course, stocks, not so much in terms of inflation or gross domestic product. The growth and inflation numbers remain high. And as a long-term stock trader, we may look at this and say, okay, well, housing prices have come down a little bit, or at least the numbers have reflected that, and stocks as well have retreated. This actually represents a good buying opportunity because we can see by inflation, the red line, and GDP, the blue line, this is actually just a minor retraction. Now, fast forward to 2020, we had that very big stock market correction. In addition to residential construction, inflation, and growth, everything went to the downside, and that certainly was a very unique black swan event, a very unique situation within our economy. That quickly recovered. Now, moving forward to today, current day, we see residential construction has moved to the downside. Inflation has come off of its highs. Now, according to the barometer, we haven't seen this dip in inflation since April or May of 2020. Certainly, that still is quite inflationary compared to what we've seen prior to those days. And GDP has come off its highs. GDP also hasn't seen these lowest lows going back to 2020, 2021. So it's a little bit difficult to tell if this is just a minor correction like we saw in 2018, or perhaps something more significant, even something that we haven't yet seen in recent days. So it'll be interesting to see what the numbers how the numbers play out moving forward. But again, the reason why I kind of chose to run the math this way is every number, every monthly report reflects its position within a 12-month ranking. So if January is a good score and February is an even better score, you're going to have a continued improving ranking. And I use that type of math because I think it's helpful to put everything in perspective to say, okay, well, the residential housing numbers are near the lowest lows we've seen over the past 12 months. Inflation, we're at about number 6 right now, 60% to 70% over the past 12 months. And GDP, although it has declined, relatively speaking, we're still much higher than we've been, for several years now. So it'll be interesting to see moving forward. Does GDP and CPI continue to move to the downside? Does that in fact classify us as a full-blown recession, or do stocks and residential construction numbers and the overall housing markets tend to recover? So every time we have some sort of economic release, it'll be interesting to see how this comes together with the big picture. Hope this has been helpful. We'll see you again soon.